A price chart tells you where a market has been, but it doesn't always tell you where it's really going. If you want to understand the true conviction behind a trend, you have to look under the hood. You have to see what's driving the engine. And a lot of the time, that engine is something called open interest. So today, we're going to break down exactly how to read it. Right? It's the question every single trader asks themselves. You see a big price move and you're thinking, okay, is there real power behind this thing? Is this the start of something big, or is it just a bunch of noise that's going to die out? Answering that question correctly, well, that's pretty much the whole game. And to get that answer, we absolutely have to look beyond just the price trend. I mean, the direction is important, of course it is, but it's the conviction behind that direction that tells you the real story. Okay, think of it like this. Price is the destination on a map. It tells you where you're headed. But these other indicators, they tell you how many people are in the car, how fast they're driving, and if they're actually planning on going all the way. It's all about measuring the strength of the move. So what are these signals we're talking about? Well, traders and technicians rely on this kind of powerful trio to get a deeper read on the market. You've got price, you've got volume, and the one we're really going to focus on today, open interest. All right, first up, you've got price action. This is the foundation, right? It's the what and the where of the market. It's just that simple line on the chart that we all know and stare at for hours. Next, we layer on volume. So if price is the direction, you can think of volume as the roar of the engine. It tells you the intensity, the oomph behind what's happening. I mean, a huge price move on tiny volume, that's kind of suspicious. But a big move on huge volume, now that's pressure. That's real intensity. And now for our star player, open interest. This is the total number of active open contracts out there. The core idea here is really simple, but man, is it powerful. If open interest is rising, it means new money is flowing into the market, fueling the trend. If it's falling, money is flowing out. It's a direct gauge of who's participating. Okay, so now we have our three tools. Let's see how the mainstream kind of momentum-based approach uses them together to try and read the market's mood and figure out what's likely to happen next. This is where it gets really interesting. By combining these signals, traders build a framework, a set of rules to figure out if the bulls or the bears are really in control. So let's break that down. So here it is. This is basically the technician's classic playbook for reading market strength. And what's really crucial to see here is that a rising price isn't always a strong signal, and a falling price isn't always a weak one. The key, the secret sauce, is how volume and open interest are acting right alongside that price move. All right, let's break down the bullish signals first. You've got the most obvious one. Price is going up and open interest is going up. Simple. This means new money, new buyers are jumping in with confidence, and that confirms a really healthy uptrend. But then you've got this other, less obvious bullish signal. The price is falling, but open interest is also falling. So what does that mean? It suggests that the sellers are getting exhausted. They're closing out their positions, they're leaving the building, and that means the selling pressure might finally be drying up. And on the bearish side, well, if the price is dropping while open interest is rising, that's a big red flag. It's a sign that aggressive new short sellers are piling in, betting on it to go even lower. But maybe the most deceptive signal of all is when the price is rising, but open interest is falling. That's not a real rally. It's just short sellers getting scared and buying back to close their positions. Money is actually leaving the market, even though the price is ticking up. Okay, so that's the textbook way of looking at it. But what if the textbook is sometimes wrong? What if following that crowd, following that momentum, leads you right off a cliff? Well, this is where the contrarians come into play. Yeah, this really is the million-dollar question, isn't it? Because sometimes the most overwhelmingly bearish signal, the one that's screaming sell at you, is actually the exact moment you should be thinking about buying. And that brings us to the infamous short squeeze. Here's how it's set up. An asset has already fallen hard. And now, a wave of, let's say, less informed speculators sees that downtrend and they jump on board, shorting the asset, betting it's going to fall even more. This makes open interest spike while the price is down, a classic bearish signal from our playbook, right? But these traders, they're late to the party, and their positions are about to become pure fuel for a rocket ship. And this, right here, is the whole conflict in a nutshell. The momentum trader sees high open interest in a downtrend and says, "See, I told you, more sellers are coming in, this thing's going to zero." The contrarian looks at the exact same data and says, "Whoa, look at all that fuel for the fire."
All those short sellers, they're going to be forced to buy back their positions when the price turns, and that forced buying is what can trigger a massive, explosive rally.
And hey, this isn't just some abstract theory. There's data behind it. As the source material points out, contrarian indicators often have a way better track record when it comes to spotting those major turning points in the market. Turns out, betting against an extreme crowd can be a very, very powerful strategy.
So who's right then, the momentum guy or the contrarian? Well, the truth is, it's not really about picking a side. It's about understanding that open interest, as powerful as it is just one tool in a much, much larger toolbox.
And this is probably the most crucial point to remember. Open interest is not a crystal ball. It's a rearview mirror. A very clear, very useful rearview mirror, but a rearview mirror nonetheless. It gives you incredible context about what has happened, but it doesn't predict the future. It confirms, it doesn't forecast.
All right, so let's just quickly recap the big ideas here. First, open interest is a confirmation tool, not a prediction tool. Second, the very same signal can be read in completely opposite ways depending on whether you're wearing your momentum hat or your contrarian hat. Third, context is absolutely everything. And finally, you should never, ever rely on just one indicator. The goal is to build a complete picture using lots of different tools.
So, at the end of the day, understanding open interest gives you a whole new lens to see the market through. You can see not just where the price is going, but the story, the psychology of the money behind that move. So the question now isn't which rule you should follow blindly. It's how you'll use this deeper understanding to read the game and make smarter decisions.